Looking at the Goldman Sachs settlement over the Abacus transaction, the settlement, the largest fine ever paid by a Wall Street firm, but the bank didn't have to admit or deny a wrongdoing. Was this a victory for the SEC?
Oh, I think it absolutely was a victory. I think it sparked a great debate about what is the relationship of a financial provider to their customers and their counterparties. And I think it showed that the SEC had the ability to sort out an extremely complex transaction, lay out those facts, and bring a case to conclusion. And as you know from talking to our enforcement director, we have some other cases in the pipeline, but I think it was an important step forward.
What do you think the net result of it is beyond the fine?
I think it does heighten very much the discussion about the quality of disclosure that's being made, even to sophisticated investors and sophisticated counterparties. I think it focuses attention on internal compliance mechanisms in a very important way, and those are some of the issues that are addressed in that case, because in addition to the fine, there were remedial steps that were being taken by the firm as well.
Do you think it changes behavior in general going forward?
I do think it does, and my understanding is from talking to other firms that they've really scrutinized both the conduct that was alleged as well as the remedies that were put in place as practices that they might be considering for their businesses. So I think these settlements and the cases we bring always cause people to stop and think, how am I doing business? Is there a better way for me to do business? And that's a good thing.
Finally, want to talk about the flash crash on May 6th. I was down at the New York Stock Exchange. What an afternoon. I can imagine what your offices were like then. You guys, along with the CFTC, just published your findings on that. It's interesting. It found that a single firm trading more than $4 billion in equity futures was to blame. This was traded on the CME. Just overall, your thoughts on the result of what you found from that, and could it happen again?
Well, I think what it points out is, yes, there was a single, extremely large, 75,000 contract E-mini futures sell order that went into the market very quickly without human intervention based on a trading algorithm, and one that was not perhaps the most sophisticated algorithm because it was based on volume and not price and time. So it attempted to execute very, very quickly. And so it really forces us to take a step back, and while now we understand the causes and we've done enormous analysis of the markets throughout that entire day, because we really had two liquidity crises, the one in the futures market and the one that flowed into the equity market as a result.
And there was a lot of finger pointing between exchanges.
Absolutely right. But I think we have a pretty definitive story now, based not just on the data, but also on our staff interviewing about 40 different market participants and weaving that into the report as well, so people could understand what different people were seeing from different places within the market. The next steps are for us, we've transmitted the report to our expert advisory committee. They will come back to us with some recommendations. But I think it points out that we really do need to look at algorithmic trading. We need to understand whether these algorithms need to be programmed with throttles in them so that they don't have the potential to run off the side of the road the way this one clearly did. We need to continue to look at whether market makers should have some obligations in the marketplace to make legitimate two-sided markets, or at least not to take liquidity out of the market when we're having big price moves. We need to continue to look at issues like stub quotes and cross-market circuit breakers. But what I think the report also shows is the steps we did take to put those single stock circuit breakers in for the S&P 500 and the Russell 1000 stocks, as well as for a large number of ETFs, were very much the right steps. Stop the market when there's been aberrational trading, give humans an opportunity to intervene, to gather liquidity back, and to open the market in a fair and orderly way. And that's what the circuit breakers have done for us over the past several months that they've been in place.
On that, though, finally, do we need more uniformity when it comes to those rules for erroneous trades, or for an algorithm, as you say, sort of running off the charts here?
We certainly need to look at what we need to do with respect to algorithms and the risk management and the risk controls that are programmed into algorithms. That's critical. We do have new rules on breaking trades. As you know, on May 6th, 20,000 trades had to be broken because they were so far away from the normal price.
Procter & Gamble's a
exactly.
great example.
There are lots of great examples, and sad examples too, which should never have happened in our markets. So those new rules are in place, and I think those will be very helpful. But we need to continue to push on this. May 6th highlights some of the issues with our highly fragmented market structure that we really need to address.